I'm joined today by Luke Hartman, the former head of equities, fixed income and alternatives at NGS Super and founder and CEO of Beantree. Luke is among the incredible investors sharing insights at the Family Office Investment Forum today. Welcome, Luke. It's great to have you with us.
Thank you for inviting me, Zelda.
Okay, let's dive straight in. What are the key factors investors should be thinking about when selecting investment managers?
Okay, so when I typically select a investment manager, I follow something which I call the 7P framework. So that's the portfolio fit, the manager's philosophy, the performance, of course, their process, their people, the partnership the manager brings, as well as the price. So each of those tells you a story about the manager. The portfolio fit is important because each manager really needs a well-defined role in your portfolio to have a fit in your portfolio. And when you add them, they really should bring more efficiency to the portfolio. So they need to improve performance, improve risk, or improve price, or improve liquidity. In terms of philosophy, what I'm talking about here is really the manager's ESG philosophy. So there, you really want alignment of your manager with your key stakeholders. So if you don't, then there's going to be problems later down the track. And of course, performance. That's the reason you invest in an investment manager. You want them to generate performance, but you really need to be able to separate out skill in their performance from luck. And in doing that, there's a lot of analytics that you need to go into and cutting up their portfolio in terms of attribution to separate out whether or not their performance has come from skill or luck. The next is process. The process is really the backbone of a manager's success. So what you look for there is really a strong, repeatable investment process supported by robust risk management. And after that, people. It's people who generate the returns. So when you're looking at people, you really want managers who are high-performing individuals who are aligned together and working well together, and who are aligned in terms of their incentives with you so that they will be motivated to perform. Next up is the partnership. When you invest with a manager, you want them to be your partner. You want them to bring you along the ride with you. You want them to share ideas, share investment, intellectual property, investment ideas, and you also need the necessity of reporting requirements for your stakeholders. And finally, price. I think of fees as something which is more of a share of the profits that you gain from allocating funds to an investment manager. And you want your fees to be fair in terms of something that around about 70-80% of the profits go to you and 20-30% of the profits go to the investment manager.
Yeah, fantastic. And we're looking at an investment manager's track record. How do you separate skill from luck?
When you to try and do this, to try and separate skill from luck, you really need to look at how the performance relates to the people and process, and is it supported by a strong process and strong people. On top of that, you really need to do a lot of insightful attribution. I like to cut a manager's portfolio attribution as many ways as I can. So I look at have they performed in terms of stock selection, has a performance come from sector exposure, country exposure, currency exposure, factor exposure. And when you do that attribution, it really tells a good story about where the performance has come from, where the alpha has come from. Has it come from a couple of single stocks, a bit of a factor tilt, or certain individuals? And where it has only come from a couple of key winners or factor tilts, and the process isn't very good, then you can't really bank on it, that performance coming from skill. Chances are it might be luck.
And what are some tips you can share for gaining valuable insights from due diligence meetings with managers?
The key thing for preparing for due diligence meetings is to prepare. So when you go in for a manager meeting, to get insights, real insights into how the manager's process works, what their portfolio looks like, and who they are, you need to do your homework beforehand. I shouldn't say it, but you should be reading the material they've sent you before time, so you're not getting read to during the meetings. Surprising how often that actually happens. The next one is understanding the key risk positions. You really need to drill down on what actually matters in that investment manager's portfolio to be able to understand what's going to move the dial. The next one is do your own homework. Do some research into some of the stocks, some of the positions in their portfolio to be able to drill down and test the manager on their understanding of those stocks and see how it links into the process that they purport to follow. The next one is don't be afraid to ask dumb and awkward questions. There's no such thing as a dumb question, and often they're the ones that provide you with the most amount of insights. And then finally, try to meet with as many people as possible from the investment manager, separately if you can, because that will give you an understanding of how the organization works together, how consistently the investment process is applied, and what level of depth the investment manager has.
And what is the right fee to pay an active manager?
I like to think of fees for active managers as a share in the profits that they bring to you for allocating capital to them. So in terms of a number, I think 20 to 30 basis points of fee per 100 basis points of alpha, gross alpha that the manager brings. So that's 20 to 30% of the share going to the manager for their skill, and 70 to 80 going to you for your capital that you're giving them to run their business. In terms of the split of fees between base or management fee and performance fee, I like to see a combination of the two, but often it really depends on what's the best value that is on the table for you, because some managers will provide a base-only fee or a base plus performance fee. And the interesting thing is the intersection of those two normally represents the alpha that the manager expects to get, maybe less a little bit for the uncertainty performance fees bring. But it ultimately comes down to where the best value lies.
Investment due diligence tends to focus on selecting managers. How should investors decide when it's time to terminate a manager?
That's a good question. In terms of the time when to terminate a manager, it often comes about when a manager's underperforming. And whilst that's a very valid case to terminate a manager because their role is to deliver performance, it shouldn't be the sole reason for determining whether or not to terminate a manager or not. The best approach is really to go and look at the underwriting that you've done. So when they're underperforming, what has changed with the manager for the underwriting you've initially done? And if nothing has changed, then you've got to question whether or not this performance is transitory or the underperformance is transitory, and you should continue on with the manager. But conversely, where a manager is performing strongly, you shouldn't think that they can walk on water. You'd really need to look at if anything's changed, if there's a change in the people, if there's a change in the ownership, if you find issues with their process, then there's sometimes very valid reasons to say that good performance isn't going to continue and you should consider terminating them. Another thing too is sometimes you change. When your Future Your Super came into Australia, the risk tolerance of a lot of superannuation funds changed. And so high active share managers, high tracking error managers were no longer necessarily the right fit within a portfolio. So sometimes your objectives change, and that's another reason you may need to think about moving on or terminating the manager relationship.
Thank you, Luke. We'll have to leave it there and get back to the forum. I really appreciate you sharing your expertise with us today and for being a part of Global Investment Institute's Family Office Investment Forum.
Thank you.